following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, and that rockin' theme means it's time once again for Options Bootcamp. This, of course, is the show where we break down you raw, unseasoned options recruits and rebuild you into something stronger, faster, indeed more powerful, and hopefully a little bit more options savvy. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And joining me on the old training ground today is my fellow drill instructor, the man with the white hat to my black hat, good old Dan Passarelli from Market Taker Mentoring. Dan, welcome back to the show to you, sir.
I am really happy to be here, I got to tell you, Mark. And holy cow, we've got some great stuff to talk about today, don't we?
I think that is the case every week, sir. We always come bringing a full load of quality material for our listeners. But you're right, today is indeed an interesting one because we're going to touch on something that is just the hot thing, the topic du jour in the world of options for pretty much the past year or so. And I'll tease that for you listeners. We'll be getting to that in a few minutes. But yeah, I'm excited, Dan. I hear you are as well. I didn't hear your woot woot this week, so I don't know what whistle you're working with over there in scenic Frankfurt.
I'm saving that one. I can't bring it out every time, Mark.
That's true. You have to give the listeners a little something to look forward to for
it's
the
called
next
overexposure.
Wouldn't want to do that, Dan. Wouldn't want to do that. We'll also be joined here on the old training ground momentarily by good old John Critchley, our fellow drill instructor from SogoTrade.com. But I think now with the team mostly assembled, we're going to dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, and welcome to Basic Training. This is where we discuss and analyze and break down some basic options concepts, techniques, and strategies, and help explain them to you, the listener, so you can implement them in your trading down the line. And today, like we hinted at the top of the show, we're pretty excited because we're going to touch on something that is just the options topic du jour, the options product du jour, the one everyone is talking about, the one everyone is trading, and that is, of course, the weeklies, these newer, shorter duration contracts that are just taking the options world by storm. I know we're inundated with requests about these products over at Insider, and I'm sure a lot of your clients over there at Market Taker Mentoring are probably bugging you about them as well, Dan.
Yeah, they sure are. I talk to my students a ton about these.
So what are these great products, these great new products, the weeklies? What are we talking about? Well, as the name implies, they're relatively straightforward. If you've been following our show at all, and hopefully you're not just tuning in at episode 12, I believe we're on episode 12 now, but you've actually listened to the first 11, so you have a basic idea of what we're talking about here in terms of options and terminology and how these products work. But if you haven't, by all means, I encourage you to visit the Options Insider or go to iTunes or Sogo Trade and download and listen to those programs for yourself. But what these are, essentially, if you've been listening to the show, you know we've been talking about a lot of different monthly contracts, front month, second month, third month. Options typically expire on a monthly basis. So you can go out right now, you want to buy let's say we're looking at December contract right now, so you buy a December front month contract, and that's what you're trading right now, and that expires in roughly a month. You can go out a couple months beyond that. But those are relatively large blocks of time. And sometimes there are traders and investors who don't want to trade over that long of a period. They just want a very specific element, a very specific event they want to hedge on or speculate around. And that's where the weeklies come in. And as their name implies, they are essentially same as options contracts, just for 1 week. So now instead of having to go out and buy a Microsoft front month call and buy a full month's worth of premium, you can now go out there if you like and simply purchase a weekly call and use that for your trading purposes instead. And as you can imagine, this type of smaller duration, more bite-sized type contract opens up a lot of interesting new strategies and ideas for you, the trader. And I think one of the first questions, before we even get into some of the strategies, one of the first questions that hangs up a lot of newcomers to options when they first start learning about weeklies, they see that they're a different expiration date, expiration cycle. They start wondering what else is really different about the weeklies, particularly from some of the other options topics we've discussed on the show in the past, like the Greeks, and how do those really differ from the weeklies. So I thought instead of rather having me go into length about that, we'll have the man who wrote the book on the Greeks, good old Dan Passarelli, illuminate us on some of the differences or perhaps similarities between the weeklies and regular options when it comes to performance metrics and variables like the Greeks.
Sure, Mark. Well, thanks. The thing about options is that the devil is in the details. I mean, anybody can just go and buy a call or, sell a credit spread or something like that. But the guys who make money trading options are the guys who know which calls to buy, which credit spreads to sell. And they look at the finer points. They choose the right strike prices. They choose the right months. And that is a big part of your decisions in whether to trade weeklies. Because here's how it works. All the Greeks are affected by the duration until expiration. And weeklies are special because they have just a real little short time until expiration, about a week when they're first listed. So let's start with delta. An out-of-the-money option is going to have a smaller delta with a weekly than it would with a conventional option of the same strike. So what I'm saying is, let's say a stock's at $50. You're looking at the weekly 55 strike call, $5 out of the money. And then you're looking at the 1 month or 2 month 55 strike call that's $5 out of the money. The weekly option is going to have a much smaller delta because there's less time until expiration. Now, what about when the underlying stock moves and now that option's at the money or in the money? Well, the delta is going to change way faster with the weeklies because it has higher gamma. That's the rate of change of the delta. And once the option's in the money, the weeklies are going to have a higher delta than the corresponding monthly or 2 month or what have you conventional option of the same in the money strike. Let's move on to time decay. As measured by theta, time decay is affected greatly by the amount of time left until expiration. Really short-term options have very, very high theta. That means their value decays really, really fast. Time premium just gets sucked out of those things like a vacuum. An option that has a week until expiration decays way faster than an option with a month or 2 months or 3 months until expiration. That's good for sellers, hurts buyers. And then finally, there's Vega. Now, I just got done telling you how much the other Greeks are so much more affected by, less time until expiration than conventional options, but Vega is just the opposite. Implied volatility, which is what Vega measures, is way less affected in weekly options. Implied volatility kind of barely even matters when it comes to weekly options because the Vegas are so small. The implied volatility can change 5 points, and a typical trader is not even going to see it show up in his prices, not even going to notice. So those four Greeks, Delta, Gamma, Theta, Vega, are all very, very different with weeklies than they are with conventional options. And you need to understand that in your trading. And if you do, it's going to make you a better trader. You're going to make better decisions.
It's interesting, Dan. It's almost like we're somewhat contradicting ourselves here talking about the weeklies because the previous 11 episodes here, we've been going on about the Greeks, and in particular, the two Greeks that everyone seems to focus on, Delta for the retail and then Vega for the more professional. But now we get into the weeklies, and that script is flipped a little bit, where those two Greeks, Vega definitely is borderline irrelevant at this point when you're talking about that small of a time horizon. Delta, less so, but still less relevant than it would be. But you're really talking about Gamma and Theta here when you're talking about weeklies, because it is such a small time horizon, and Gamma and Theta obviously have that inverse relationship to each other, so wherever there is Gamma, Theta is not lurking far behind, and vice versa. And as you mentioned, these contracts are such short-term contracts that decay really becomes a big factor, as a lot of people who are trading them have discovered. And also Gamma, because that Delta can change in a heartbeat with just a minute swing in the underlying. And so if you're going to be trading weeklies, you really need to be cognizant of the impact of Theta and Gamma on these contracts. And, let's talk a little bit about how these things are traded, because it's interesting the way they were constructed and how they were theoretically intended to be implemented versus how they've been used in reality. And these products were cooked up a few years back, and they were really intended, like I said at the top of the show, to allow stock traders, investors, and other traders to really hedge short-term event risk, earnings, special announcements, things like that, where you don't need a whole month's worth of premium to hedge that one event. So the concept of one that you're on these products was a long premium product to hedge a specific event. Then they launched, and they really took off in the last couple of years. And over that last couple of years, we've seen an explosion in volume in the weeklies, and almost all of it, except for a small fraction, really has come on the other end of the spectrum. It's the selling end, and that gets to what we were talking about earlier with the decay in these weeklies contracts. The time cycle, the time to expiration of these contracts is so short, you can literally see the decay coming out of them throughout the trading session. So a lot of people realized that, and what happened was this massive rush to sell these contracts to the point where the vast majority of the volume is really sellers looking to take advantage of that rapid decay. Now, that works in a lot of scenarios where these contracts go to zero very quickly. Of course, we've seen a lot of people also use them in scenarios where it wasn't really the ideal. I think people writing weekly downside puts on Netflix last year before it dropped from 300 down to around 100 or so comes to mind. Those contracts
Ouch.
Really, that they can certainly sting the weeklies if you're writing them willy-nilly without paying attention to some of the other mitigating underlying factors that go into them. But it's an interesting thing, and part of that was also because the way the products were listed, particularly on the equity option side, which is most of what our listeners are trading. They started listing them with the front week, essentially, and then 1 week beyond it once you got a little bit into the trading cycle. So you had essentially 2 weeks to play with for the most part. But that was about it. What we saw on the futures option side was something a little bit more rational. They listed an entire month's worth of weekly, so week 1, 2, 3, and 4 all at once. And that allowed a little bit more nuanced trading. You could buy week 3, sell week 1, do time spreads within a month, and diagonal trades and things like that. And that opened up a lot more interesting, nuanced trading strategies. And so what we saw on the futures option side was a surprising shift towards buying and long premium on the weeklies, particularly in the final couple of days of the contract's lifespan. People were using them as they were originally intended on the futures option side. They were actually buying them to hedge specific events like crop risk, crop reports, that sort of thing. We didn't see that as much on the equity option side. Now, what we've seen in the last very recently, actually, in the last few months, is a change to the way the equity and index options are being listed. And they're kind of aping what's been going on the futures options side. They're now listing the full strip as well. So it's not just week 1 and a little bit of week 2. It's really the full strip of 4 weeks. And in fact, it came as a surprise to a lot of people when it showed up on their trading screens over the past couple of weeks. They've added a 5th week in some names now. I know we've been getting a lot of feedback from people on the site. What is this extra option I'm seeing on my screen? People thought they were trading a monthly contract. They were actually trading week 5. So you actually have a very wide array of weeklies at your disposal now when you're looking to trade them. And that opens up, like we said, a lot of really interesting concepts like time spreads within the month itself, and other interesting concepts, ratios, financing your longer term hedge with some near term sales, and vice versa, to really make the product and the trading styles around them a little bit more nuanced. Now we're joined here, listeners, by John Critchley. He is, of course, the options specialist over there at Sogo Trade. And I know a lot of the brokers we work with, John, have really seen an explosion in interest in the weeklies on the part of their customers. I'm assuming you've seen a similar explosion over the past year in weekly interest over there at Sogo Trade.
Yeah. Hi, Dan. Hi, Mark.
Hey, John.
Yeah, we do about 20-25% of our business, and actually much higher sometimes in the weekly options. It has been a very, very successful launch, an idea that I think was created by the SIBO a few years ago. And what I try to recommend or tell our customers, and most of our customers have a tendency to be more premium buyers, and the weeklies are great for, as you guys mentioned earlier, for event risk, for earnings. And going back to the Greek discussion real quickly, I agree with everything you guys said. The Vega, I tell my customers when I write about it for my blog or for articles, is really irrelevant. You're looking for the weeklies. You're really looking for the premium over parity, because the Vega calculation with the Black-Scholes or different model can really become skewed or become outsized, and it's really hard to gauge. So really look at the premium over parity, for the weeklies. But they've been just a windfall for the retail brokers. And now I think a few weeks ago, as Mark mentioned, I think in 10 underlyings, Apple, Bank of America, and some indexes, ETF spiders, they listed, weeklies 5 weeks in advance. And that actually confused a lot of our customers. And I think that it's a good idea, but I think the exchanges should be careful that they don't saturate the market with too many weekly options. Or, at what point are we going to have a time in the future where they list weeklies a year in advance? I mean, at some point, enough's enough, and we'll see how this plays out. But so far, so good, and the weeklies are just a great trading vehicle for the retail customer.
John, financial engineers get paid by the product, man. They got to keep creating new products.
I mean, I'm waiting for the day where we have daily options. I know that's coming.
It is coming. That is coming. That is the next logical step to this. And there has been actually some hesitancy on the part of the exchanges. Exchanges are not known for hesitancy, as you've just illuminated, and they're not known for reluctance. If a product works, they'll keep hitting it until it's done to death, quite frankly. But and the natural progression of weeklies has been to daily. Surprisingly, there has been some reluctance on the part of a lot of the exchanges that we've spoken to, and as well as some of the brokerage firms, because there is just in the general investing public this perception of options as inherently risky, inherently dangerous, inherently oriented around gambling. Even though, as we've discussed on the show many times, that is a very false perception, still it exists to a very great degree amongst the investing public, particularly the audience for this show, the retail investing public. So the exchanges, the brokerage firms, are very loath to really enter into any sort of new product category that could potentially be seen as adding to that gambling connotation. So some people, the respectable ones at least, are very hesitant to get into dailies. That said, they will be coming. I think it's just a matter of time. The extension of the weeklies kind of just proves that. Was anyone clamoring for a week 5 weekly? I don't know if I was.
I think it was trader driven. I think it was market maker driven. I think that was the primary driver behind it, I believe. And I think that they should just be careful that they don't list too many products and start confusing the public with this smorgasbord of option, months and strikes. And they should be careful, I think.
All right, and that's going to do it for our basic training segment where we've done a little bit of an outline and an overview of what weeklies are. Now we're going to dive into our options drills and talk about some ways you can implement weeklies in your trading.
Well, in Boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
Sir, yes, sir. It is time for options drills. And this is a fun little segment we like to get to whenever we have time. And this is the segment where we try to break down some strategies with some of the topics and products that we've just been talking about in the basic training segment. Of course, today we're talking about weeklies. And it's interesting, even though I mentioned the weeklies were created for hedging uses and hedging purposes, what we've seen develop is, of course, a plethora of selling strategies around the weekly. So most of the strategies you see right now that employ weeklies to some degree really revolve around a selling component. The most basic and some of the ones we tend to, I don't really recommend here on the show, particularly for this audience. The basic audience is, of course, people racing out to sell downside puts or naked upside calls or what have you in the weeklies because they see, for whatever reason, they think these products are going to expire worthless, the stock's going to stay where it is, things like that. We've talked about selling naked puts a number of times on this show in the past, and of course selling naked calls. And all those risks apply tenfold for the weeklies because they could, of course, blow up in your face in any one direction in a short period of time. So we're not going to sit here and talk about naked selling, for example, because A, that's not that exciting, and B, it's not really that suitable for this audience. But that said, there are some interesting strategies that you can employ. One of the more interesting ones I've seen come about, particularly as we've seen, like I said, this strip of weekly contracts come into being, is using weeklies in some more nuanced ways as diagonal spreads to finance some longer term hedging, some longer term, and by longer term I mean 2 or 3 weeks, versus using some very, very short term contracts to finance that. So as over the past few months, we've seen an explosion in the equity and index options side on doing some interesting diagonals within the weekly months itself. So what we used to see is people coming out and just buying a monthly contract to hedge. Now what we have with the existence of the weeklies, they can buy the monthly, which is essentially week 4, or a lot of times they'll go to week 3, whatever suits their hedging purposes, to put on a hedge, perhaps a downside put there, and then they'll write the corresponding other put in the front month, maybe, or the front week, I should say, week 1, maybe week 2, and they'll use that as a spread to help offset the cost of their protection and allow that, and then keep rolling that spread all the way through until they get to their protection week. And that's been an interesting strategy. Of course, like we said, weeklies are heavily gamma-oriented contracts. That's a very short gamma strategy. So if you're going to go into that, you need to know the details of how that works and how that implements your trading. But that is an interesting strategy that we've seen popping up, particularly over the past few months and weeks, as these contracts have had more of a nuanced way that they've been listed and rolled out to the crowd. Of course, I was surprised, John, that you actually said earlier that the bulk of your customers are premium buyers. That puts you guys in a rarefied spectrum when it comes to options brokers. That most of the customers we've seen floating around out there tend to lean toward the dark side. So then for those types of customers, there'd be a lot of interesting strategies we could discuss on the weekly premium buying side. Of course, the initial reason for these contracts' existence was to hedge earnings events in particular. So that is, of course, the most basic, most simplistic way you could use a weekly option. Let's say you're long the stock and you're going into Microsoft earnings, and then the following day you can pick up a couple of days worth of a weekly or maybe a 1 week contract as a near-term downside hedge for a put if you were very concerned about very near-term risk. Now, of course, we don't really counsel buying contracts into earnings that often because of all the other commensurate risks we've discussed, premium, gamma, theta, that sort of thing, Vega imploding. But like we said, Vega not really a factor with these contracts, so it's really just a decay model. So if you're okay with the decay for a couple of days, it's a worthwhile trade to put on, particularly if you're very concerned about very, very near-term downside risk in a particular underlying. Dan, when you're talking to your clients over there in market taker land, I'm sure a lot of them are coming to you with this specific question. I want to trade earnings I want to trade weeklies in and around earnings. What are some of the strategies you're working to put them on? Are you getting them into maybe weekly verticals or ratios or calendars? What are you working with over there?
Well, it's all situational, really. It depends. Basically, there's one of two things: either the long call slash long put, either one, or the vertical. Now, a debit call spread, or a debit put spread for that matter, is the classic volatility hedge for an earnings play, because you're getting long vega and you're getting short vega. They offset each other, and shazam, you're able to hedge off just about all that while still maintaining a lot of the directional sensitivity that you actually want being an earnings player. But sometimes I like to consider that for some of my students, but also just simply going out and buying a call or buying a put, because the vegas are so small, can be an excellent play with earnings as well. And it's funny, we can kind of go back and forth and say, well, yeah, the original purpose for these might have been being a long hedger, a long option hedger, but then a lot of people started seeing the advantages of being a seller. But there are, even as a trader, there are advantages to being a buyer. And that kind of sounds like I'm contradicting what we both have already said, but I'm not. There's advantages to both. There's the obvious time decay advantage to being a seller, but being an option buyer, the advantage is those options are so cheap when there's only a week or less until expiration, and the vega risk is so low because the vegas are so small. And the real advantage to being an option buyer when it comes to weekly is that gamma, and gamma is the most underrated Greek out there. People don't even think about it. But what gamma enables you to do is take one of these somewhat out of the money calls, and if earnings works out your way as planned, I mean, you can get a few 100% on your return, because gamma takes those from being a teeny little 15 delta option to being a 90 delta option. They increase in value exponentially really, really fast. So low risk because they're cheap, incredibly high reward because of the gamma.
It's interesting. We don't, like I said, we don't counsel too many super long premium strategies on this show, just for the many of the reasons we've outlined on previous episodes. But the weeklies do make them a little bit more palatable, partially because they're bite-sized, partially because they're focused around specific events. And also, if you are concerned about the premium exposure, even in a very low premium contract like a weekly, you can get into verticals, you can do other things to really offset a lot of that premium exposure. So your net outlay should be relatively nominal compared to the amount of exposure you can have in the underlying for that particular event. Actually, we should also, before we go on, probably mention some of the other interesting ways you can use weeklies, not just from a strategy perspective, but just from an informational perspective. We've always talked about on this show and others about the value of straddles when looking at events like earnings, because people always talk about analyst predictions and analyst numbers and whispered numbers and all that stuff. I really tend to throw that stuff out the window. When it comes to an earnings event or anything like that, if you want to see what real actual money is predicting in looking how far the underlying will move, you can look at a front month at the money straddle, and that will tell you really all you need to know. That's what the market is pricing in for the potential movement range of that underlying. Now that we have weekly contracts, that takes that analysis really one step further. And before, you were looking at a monthly contract and all of the month's worth of premium that was built into that number. And so you can have a rough estimate of what the market was predicting, but there was some slop, some fudge factor built in there because you had an extra month's worth of premium also built in. Whereas now we have these weekly contracts. So if you're looking at a specific event and you're wondering, hey, what is the market really predicting or anticipating for this type of event? The weeklies are fantastic tools for that. You can go and pull up a straddle with 2 days to go or a week to go, and that gives you a much better indication of what the market is really truly pricing in with an upcoming event like an earnings announcement or a new drug announcement or whatever the case may be for a particular underlying. So from an informational purpose, the weeklies also have a great deal of value. And we should also stress too, we talked about verticals and a lot of other strategies right here for the weeklies, but we should mention that all your other strategies also can be implemented in the weeklies. You can do your favorites, your ratios, your iron condors, things like that. They're just a little bit harder to pull off effectively in the weeklies. If you're writing weekly iron condors every week, I guess to be A, a lot of contracts, B, it's kind of hard to chase all that premium down. It can work. It can be an effective strategy like it can in the monthlies and other contracts, but it takes a little bit more doing and, of course, a lot higher from a commission perspective. Of course, when we're talking about weeklies also, we've talked about covered calls in the past on this show, there's been a great deal of research done on moving your covered call liquidity forward in time. So in that sense, I should say into shorter duration contracts. So analyzing, let's say, writing a 3-month call versus the 1-month call and versus the 1-year call and all the different benefits that go into that. I've discussed that specific topic on a recent show talking about our mistakes and misconceptions of the options market, writing leaps versus writing 1-month options. Well, if you boil that analysis down even further, and some great research coming out of Russell and others has backed this up now, where if you take that writing a 1-month call and roll it up to a 1-week call, now the amount of premium you're capturing and harvesting over the course of that year is dramatically increased, even versus the 1-month call. Of course, there's some inherent downsides to that. It's 4 contracts versus 1, so your commissions are going up. It's a lot more work. So if you're a busy trader or a busy investor with the day job, or you're a money manager out there managing a lot of money, it might be hard for you to implement those strategies. But if you're looking at some of the strategies that we've already discussed and looking for ways to improve your bang for your buck out of them, and if you have a lot of long equity positions and looking at covered calls anyway, the weeklies are an excellent choice for that sort of strategy as well. Now, John, when someone calls you up or emails you over there at Sogo and is talking about weekly strategies and different types of methods they can employ using the weeklies, what is your typical advice to them over there at Sogo?
Well, let me say, let me just go back to a point you brought up that I 100% agree with. The market makers put their money where their mouth is. So if you look at an earnings event and you look at the straddle in Amazon or Apple, and it will tell you that the straddle's priced at maybe a 7 or 8% move. And guess what? Most of the time, the market makers are pretty dead on. I mean, you'd be surprised how close these guys are to, again, because they're putting their money on the line. So what I try to advise, and when I write about it, and again, I always say when I write, I say, if you believe this, you consider doing this. But if you don't want to buy a straddle, and that's too much money, and you're worried if you sell it, that you may blow out, if you can do a butterfly, a put butterfly or a call butterfly, and use the straddle, like you said, Mark, that will tell you where the market is pricing in the move. So let's say up 7%. So if you take that 7% number, and then you look at the underlying, if you can put a butterfly on up 7% or down 7%, it's a nice little trade. You're gambling, but you could put it on for 20, 30, 40 cents, and maybe it goes to $5 or it goes to $4. So that's some of the strategies that I write about. And again, I just want to stress that the weeklies are we have a lot of customers that again like to buy premium, and why the weeklies are so great is because of the fact that you can buy an option for a nickel or dime. You can gamble, but you can really get a bang for a buck. We have customers that bought some Groupon calls, for a nickel when the stock was, I think, $3.85 yesterday, and today it traded up to $4.30. Well, those calls at a nickel are now worth 30 cents. What kind of return is that? So that's why the weeklies are so popular with a lot of our customers. And so we just keep stressing just to know if you're going to sell them, just know your risk. And if you're going to buy them, the risk is predefined. So that helps a lot of traders out.
Yes, they are an interesting product category, and we've just touched on the surface here today, but we wanted to give you an overview because they are so popular, and we're seeing a lot of very new customers being lured into these products, particularly because of the lower price point. People come into options quite a bit. They want to buy premium, they want to buy a call, they want to buy straddles, whatever the case may be. Then they see how expensive it is to buy ATM or even in the money front month options. So they start migrating to out of the money. So in that sense, the weeklies are nice because they allow you to trade a little bit meatier options from a trading perspective without the commensurate increase in cost. So in that sense, hedging a specific event, that sort of thing, weeklies are fantastic. And as John said, everything you do in a weekly, as long as you're aware of your risk, they can be a great way to do it. You can implement any of your favorite strategies in the weeklies. They work very similar to other contracts, except for the differences in some of the Greeks and performances that we described at the top of the show. So take those into account when you're trading your weeklies. If you're primarily a Vega trader, It's going to be a little bit different for you trading weeklies than it is trading front month or a 3-month or 6-month out contracts. And if you're one of these regular strategy traders where you implement a typical strategy time and again every month, like a covered call or others, weeklies are fantastic for you. Weeklies are also interesting if you're doing things like collars and other strategies like that, where you can roll your long premium element out, let's say the long put out a few months, 3 months maybe, and write weeklies against it. That could end up being a great way to not only get very cheap protection, but actually even generate income on top of that, the cost of that put, so you end up generating additional profits and income from that collar position. So there's a lot of interesting ways you can incorporate weeklies into existing strategies that can give you some nice bang for your buck. Today was just a bit of an overview. Maybe we'll get into some more detail on an upcoming show. But right now we're going to close out our options drill segment and dive into our mail call, where we give you a chance to join the show.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to Mail Call. This is, of course, where you, the listener, get your chance to sound off and join Dan and John and myself here on the old Bootcamp training ground. Our first listener mail comes in actually via tweet from J-Jax here, and he writes, this is one for you, John. He writes, does Sogo Trade offer weekly options? And then he says, what approval level do I need to trade them? Thanks, love, Bootcamp. So, John, pretty straightforward one. I believe I know the answer to both, but why don't you inform our friend J-Jax here about weeklies and your approval levels over at Sogo?
Yeah, weeklies are considered the same as regular options. So if you're approved for, we have 6 different levels. Level 1 is covered calls. Level 2 is buying calls. Level 3 is spreads. Level 4, naked puts. Level 5, naked calls. And level 6 is the naked index calls and puts. But if you're approved for any of the different levels, the weeklies apply. So you can trade the weeklies and the regulars, and you can mix and match and do spreads, and there's no weekly restrictions anywhere.
Yeah, like we said, weeklies are essentially like regular options in a lot of ways. So the approval levels should be the same for most of your brokerage firms. If you can do it in a regular monthly option at that approval level, you can do it on a weekly. Same thing. And thanks for the love of the old Bootcamp there, Mr. J-Jax. All right, we have an email coming up from Theodore in Houston, and he writes, how long does it really take to learn options and become a good options trader? It's a little bit more of an esoteric type question. Let me just toss it to you, Dan. I'll read the rest of the question later.
Sure. How long does it take to become a good option trader? At least 3 days, but probably a whole lot closer to 20 years. Here's the thing. My old boss, when I was down on the trading floor, the guy whose firm I traded for, traded his money, was a very successful trader for many, many years before I even met him. One of the greats ever. And he'd been trading at least 20 years before I met him again. And what he used to say is, I'm still learning to trade. I'm still trying to get better. Accountants, doctors, lawyers, they all have to go through continuing education. Well, you do too as a trader. You should always be learning. Now, there's what's known in the educational sphere as an S-curve or a learning curve, where when you first start learning, maybe it's kind of clunky and awkward, but then once you get down the basics, then you can learn really fast, and you learn a whole bunch, and you get that core of knowledge that you need to succeed. And then it kind of tapers off, and then, you learn a little bit here and there over the rest of your career. So I'm kind of taking the long way to answering your question. I would say in about 3 months, if you put in a lot of effort and really spend a lot of time, you can make some really, really great headway. Put in a little bit more time after that, you're going to get even better. But 3 months of really concentrated study, I think you can really make some great headway.
All it takes is about 11 or 12 episodes of Options Bootcamp, and you're ready to go.
Ah.
There we go. Just a few hours, about 12 hours, half a day, and you know everything you need to know for being a good options trader. Now, that's a great question there, Theodore from Houston. And, the answers differ, but I think you're right. I mean, it depends really what your goals are. If you want to be a professional high-end options trader trading all day, whether it's at home from your screens or something else, that's obviously a little bit more investment in time. If you want to do what we're talking about a lot on the show, which is implement options into your equity trading and use them to hedge effectively, generate a little bit more income, manage risk a little bit better, that's a much more manageable goal. And that's something you can easily do by, listening to shows like this and then going out, picking up some books like Dan's books, checking out websites like mine, of course, which is the Options Insider, going to services like Dan's, or checking out some of the great educational stuff they have over there at Sogo Trade. There's a lot of really great stuff you can use to arm yourself. And once you understand the basic mechanics of how these products work and how you can implement them into your regular trading, the rest will flow from there. So I think Dan's guesstimate of around 3 months to arm yourself with the basics and being able to incorporate these strategies into your typical everyday trades, that sounds like a pretty good level. And so, of course, add an extra 12 hours for listening to all of the episodes of the show, and then you're good to go. Last up, we have an email here. John, did you want to jump in on that at all?
Yeah, I just wanted to say one thing real quick about that. That's the reason why firms like Sogo Trade, we have different option levels. So when you apply for options, there's a questionnaire, your experience and in stocks and options, your income and your investment experience. So we look at that and we won't approve you for a high level unless we think that you're ready for it. So if we'll approve you for level 2 or level 1, depending on if you're inexperienced. You can buy calls and do cover calls. So I tell the customers, start small, do the cover calls, buy some puts, learn more, read books like Dan's, go to the education sites. We become more educated, go to level 3 and then level 4. So again, it may take some time, but start slowly, and we will not approve you if we don't think you're ready.
Yeah, so when John hits the green button and says approved on your account, then you are ready to go. And last up, we have an email from Alex S. out of Tulsa, in the neighborhood there of good old Theodore in Houston. And he writes in, my financial advisor doesn't know anything about options and doesn't seem inclined to learn. Should I fire him? If so, where do I find an advisor who uses options? Well, that's an interesting two-part question. One of them is a little easier than the other. I think the first part of what really alarms me about your thing is not that your advisor doesn't know options. That's pretty much standard procedure. That's par for the course in the advisor world. Most advisors are completely ignorant of options, which is a shame. That's why we have a show on my network called The Advisor's Option to help educate advisors about specifically those topics so they can come to the table armed with some of the information that we're presenting to you here on this show. But, the fact that he doesn't seem inclined to learn really kind of sets off my alarm bells there. That I don't think you want an advisor who realizes there are things out there that he's not capable of doing or understanding and doesn't really seem capable of at least adding those tools to his arsenal in some way, shape, or form, in particular options, because these are such great risk management tools, and he should be using them to manage the risk on your accounts and do things like that. And the fact that he's not doing that, that's a little bit disturbing to me. The fact that he's not willing to learn, even more disturbing to me. So I think, yes, you probably should be looking elsewhere for your financial advisors because they're not cheap. If you're going to spend that much money, you should have someone who brings as many tools to the table as possible. The latter part, where do you find an advisor who uses options? That's a much more difficult question. As I said, there aren't many. And there certainly is no real listing of here are the advisors who use options. And we built up a great network over here at the Options Insider of working with some of the advisors who do handle these products and use them. So you can certainly shoot us an email. We can maybe walk you through some of the places you could find these people, but there aren't many. They're diamonds in the rough. So if you do find one that is good and cognizant and very skilled in options, they are indeed a difficult thing to find, so hold on to them or at least use them for some of their options knowledge because it's a valuable thing. Dan, John, you guys have anything to add on this?
Your advisor is the person who is responsible for managing the risk of your wealth. If he just decides not to use the one exchange-listed, conventional, best risk management tool available, I don't know if that's the guy I'd want managing my money, quite frankly. So, yeah, I kind of agree with you, Mark. I think the reason why some of these guys don't want to learn, it's because, well, I can cram this guy in a mutual fund and go play golf, or I can actually do my job and actively manage his risk. I make the same either way. I'm playing golf. Right?
Yeah,
I mean, that's kind of how it
it's
goes.
an unfortunate fact of life on that side of the fence that a lot of advisors' skill sets actually lie more on the sales side than the actual money management side. They're very good at building up what's called AUM, assets under management. Actually managing those assets is a little bit of a different story. So sounds like you might have fallen into one of those camps, and if that's the case, then I encourage you indeed, sir, to look elsewhere because it's your money. It's important. You want to make sure you have someone who's very skilled and knowledgeable handling that money for you. All right, thank you for that, Alex from Tulsa. And that's going to do it for the mailbag. I want to thank all of you who wrote in for this week and helped join us on the old show today. Great questions. If you'd like to join our friends Jay, Jax, Theodore, or Alex, then by all means shoot us a question via our comment form on theoptionsinsider.com. Direct message us on Twitter. We're just at Options. Find us on Facebook. A lot of different ways you can find us. Or just shoot us a question. Questions at theoptionsinsider.com. Put question for Options Bootcamp in the subject line so we know what show you're referring to, and maybe you can join your fellow listeners here on the show. But like I said, that's going to do it for Mail Call. That's also, unfortunately, all the time we have this week for Options Bootcamp. But before we go, let's check in with some of my cohorts here on the old training ground to see what they have in store for you, the listener. Starting off with you, Dan. I know you have the new group coaching thing going on. How's that coming?
Oh man, the group coaching is going fantastic. I mentioned on the last show, for those of you who were listening, our group coaching was twice a week, just Tuesdays and Thursdays. It became our most popular class by far, so we decided to go every day. So now our students can sign up and get trade ideas, education, and be actively engaged in the market with somebody who's been in the industry for 25 years. And you can do that every single day now. Our students love it. You know, it's a really awesome program.
Again, that's at markettaker.com if you want to learn more about that and all the other fun stuff Dan has going on. And of course, John, what is coming up in the land of Sogo Trade? I know you've hinted at some very interesting stuff coming down the pike. How are those looking? What's the prognosis on some of those developments like the application that you mentioned on the last show?
I think the application is probably by the end of the year. I've been testing it every day, and it looks really fantastic. And the one thing about the application, which is so great, and this ties into the weeklies, when you have more and more products on the marketplace, there's much more data that comes in. There's millions of quotes per second, especially around 9:30. So as the exchange keeps making more and more quotes and more and more data has to go through these pipes, that it's going to slow them down. And if you have an application-based option platform, the quotes are going to be faster. And this is no matter what online broker you have, you want to have application-based. So we're going to have that in about a month. We're still going strong on Twitter, Sogo Trade Option. We're hoping for a mobile app in the next month or two. And we're real excited about, in the next month or so, some webinars with a special guest host, which I can't mention right now, that we're still talking to. And we're real excited about that. And that's about it.
If I were you, I wouldn't trust that special guest host. I've heard nothing but bad things.
I think it sounds like a very exciting webinar series myself.
Listeners, if you can't get what we're hinting at, then just play the guessing at home game. But unfortunately, that is all the time we have for Options Bootcamp for this week. We, of course, all of us here on the old Options Bootcamp Drill Instructor Squad want to thank all of you out there in the listening audience for downloading and streaming and indeed writing into the show and making it such a success. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.